cheap stocks are back. After more than a decade of growth stocks beating value, here we see the Vanguard Growth ETF, ticker VUG in purple, absolutely obliterating the Vanguard Value Fund, ticker VTV, and the overall market in the 5 years to 2022. But now forces are in play that have brought value back for the win. Since 2022, cheaper value stocks have lost just 1.3% versus a 12% drop in the market and a 24.8% crash in that growth stocks fund. Hey Bowtie Nation, Joseph Hogue here with the 11 cheapest stocks in the market right now, the cheapest stocks to buy in each sector of the economy. I'm going to explain why value stocks are winning once again, along with the best stocks to buy. We've got a lot of stocks to watch though, so let's get started with healthcare and shares of DaVita Inc., ticker DVA. DaVita is the leader in kidney dialysis centers, and unfortunately, this is something of a growth market, affecting nearly 800,000 Americans and expected to grow at nearly 7% a year to a $196 billion market by 2030. Shares here trade for just 0.71 times sales, a 29% discount to the long-term average of 1 times price to sales over the last 5 years, with a PE ratio also at a 20% discount. These are the core measures of valuation that we're going to be using, comparing the current price multiples against each stock's long-term average, as well as competitors to find the cheapest stocks. DaVita is so cheap, in fact, that it's Warren Buffett's largest stake in terms of percentage owned. Buffett's Berkshire Hathaway owns over $3 billion in DVA, which gives him control of 40% of the company. Shares hit $130 each just last August, and a move back to that long-term valuation on sales would take it right back there for a 54% gain on the current price. Now in the video, I'm going to be highlighting just one value stock for each sector, but I'll also reveal a couple that nearly made the list. Here like Walgreens Boots Alliance, ticker WBA, and CVS Health for healthcare stocks. You Bowtie citizens out there are probably tired of hearing me talk about Medical Properties Trust, ticker MPW, but besides that 11% dividend yield, it also happens to be one of the cheapest real estate stocks. MPW is the second largest owner of hospitals in the world with 442 properties and a rare international exposure for a REIT, operating in 34 US states and 9 countries. It's about 60% of the portfolio in the US, but also 22% in the UK and throughout Europe. I really like the healthcare segment of the real estate market. We're only getting older, folks, and that means strong demand for medical services. All real estate stocks tumbled last year, with MPW down even more on worries of hospital solvency, but this stock now trades for just 7 times funds from operations. That's the valuation measure you want to use for real estate trusts or REITs, not price to earnings, because earnings just don't reflect the true cash flow for real estate companies. That 7 times valuation in FFO, though, for MPW is just half the 14 times FFO average valuation across the sector, and even that is lower than the 18 times average multiple over the last 5 years. So with MPW, you're not only getting a stock cheaper than its industry, but also an industry trading cheaply right now. Nearly making the list of cheapest real estate stocks was AGNC Investment, WeWork Inc., ticker WE, and Host Hotels, ticker HST. WeWork is an interesting one here on the shift to remote and freelance work. As someone that has been working from home for more than a decade, I can tell you the ability to get out and go to some of these co-working spaces every once in a while is golden, and WeWork could be a great long-term play. We're just getting started on our list of cheap value stocks, but why should you be investing in these? Looking back on the graph for growth versus value stocks, so the Vanguard Value Fund in green here against the Growth Fund in purple over the last 5 years through 2021, it seems growth stocks should be a no-brainer. Understand though that value stocks have beaten growth for long periods, in fact about half the time over the last 40 years. This chart shows outperformance of value over growth in blue and vice versa in orange. While growth stocks boomed over the last decade, the decade before was all about cheap stocks. And why that is, and why cheaper value stocks could once again outperform is pretty simple actually. It all comes down to interest rates. When rates are low like they have been over the last decade, growth stocks with their future cash flows are worth more because of how that future growth is discounted to present value. When rates rise though, like they have been over the last year, value stocks with their dividends and current cash flow are the stocks you want to buy. With inflation looking surprisingly persistent, interest rates could be higher for a while, and those value stocks could be your best bet. I highlighted shares of Citigroup, ticker C, and its 4% dividend as my favorite value stock last year. All you out there in the nation know I've been following banks as my favorite sector right now. The net interest margin, that's the difference between the rate banks pay on those savings accounts and the rate they collect when they lend out the money. That key profitability for banks just fell off a cliff over the last few years, but is now heading higher. In fact, Mike Mayo, managing director at Wells Fargo, is estimating that profitability from that net interest margin over the next 2 years could be the highest it's been since the 80s. The Fed published its stress test on the banks late last June and found that the industry capital requirements so strong, analysts expect the largest U.S. banks to return more than $80 billion to shareholders in dividends and share repurchases this year. Citigroup trades for a price-to-book value of 0.55 times. That's a 25% discount to its own long-term average and well under the industry average for banks. A re-rating back to 0.75 times book value and strength in lending once the economy starts growing again could take these shares back to $80 each for a 56% return. Now you'll notice here, I'm not just highlighting the very cheapest stocks across the entire market, but the top value stocks in each sector. This is an important difference because if you just bought the 10 cheapest stocks across the market, you're going to get a list entirely of retailers, grocery stores, and home builders, those that are just industries that are just cheap right now. But of course, this would leave you entirely exposed to the trends in just a few industries or sectors instead of the opportunity to find the cheapest stocks wherever they may be. So instead here, I searched each sector of the economy for the cheapest stocks, the best value stocks to buy right now, to give you a complete portfolio. In the tech sector, shares of Intel, ticker INTC, are probably the only cheap stock on the list that I'd still be very cautious about. Intel does trade for just 1.8 times on that price to sales basis, well under its own 3 times multiple over the last 5 years, and a fraction of the competitors' valuations, like 5 times sales for shares of AMD and 20 times price to sales for Nvidia. But of course, like you need to do with any cheap stock you find, you have to ask yourself if those shares are cheap for a reason. Yes, shares of Intel trade for less than a third the valuation of AMD, but Intel also saw its earnings drop 31% over the last year, while AMD booked 16% profit growth. I highlighted the difference in our This versus That series a few weeks ago, working through the horrible 5 years Intel has had on that missed development and production schedules. Intel used to be the runaway leader in semiconductor development, but when its 7nm chip was delayed, and then the 10nm chip was really only good for laptops, AMD just ate its lunch in that data center chip market, and Intel has never recovered. Now the CEO is trying to split the company's focus, promising a Hail Mary in chip design, and launching a chip foundry service for other companies. I'm doubtful the company can do either separately, and trying to do both at the same time doesn't have a snowball's chance in hell. That's why here, I'd probably prefer shares of AMD, even though they are more expensive, but I will admit, if somehow Intel can pull it off, it will be a lottery ticket investment, and the rebound could be one of the best returns of this decade. Honorable mentions here for the cheapest tech stocks go to Dell Technologies, ticker DEL, and Avnet Inc., ticker AVT. We've still got 7 more cheap stocks to highlight, but first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. The cheapest stock in utilities is also one of the best dividend growers. NRG Energy, ticker NRG, with its 4.4% dividend. The company is one of the largest energy producers in the United States, with over 6 million residential customers and 14 gigawatts of generation across electricity and natural gas. Operating in that regulated utilities market means consistent cash flows, and smart acquisitions have helped it to increase cash flow to the point that the company has been able to grow its dividend from just 3 cents per share in 2017 to 38 cents per share last year. That's a 66% annualized dividend growth. A weakness in the solar and alternative energy segments have hit the shares, now trading for just 0.26 times sales. That's a 68% discount to the longer-term average, and even the price-to-earnings ratio of 6.6 times is about half its fair value average. Utility stocks will never make you rich, but it's one of the most consistent parts of the market, and anytime you can buy in at this kind of a discount, you're going to do well along with that dividend yield while you wait. Nearly on the list for cheapest utility stock was UGI Corporation, ticker UGI, at its 0.82 times price to sales ratio. Steel producers are some of the cheapest stocks in the basic materials sector, and Cleveland Cliffs, ticker CLF, is the cheapest among them. Steel makers have taken a hit on weakness in the automotive industry, as well as just a general slowdown in the economy. Shares of CLF now trade for just 0.45 times sales, exactly half the longer-term average. Steel and most industrial stocks are highly cyclical, plunging when the economy falls and surging on the rebound. Now is a great time to start a position because you know the industry is going to recover and mature companies like Cleveland Cliffs will survive. Even on weakening earnings, the company is still cash flow positive, paid off $1.1 billion in debt last year, and bought back $240 million in shares. Almost making the list for cheapest material stocks was Schnitzer Steel Industries, ticker SCHN, and Dow Inc., ticker DOW. Even on the huge rally in stocks in the communication services companies earlier this year, there are still great deals to be found, including streaming service giant Paramount Global, ticker PARA. Of course, stocks and streaming companies sold off hard last year on a drop in ad revenue as companies pull back on marketing. That combined with increasing costs to push out more movies and shows to stay competitive with Netflix and Disney and all the rest meant lower revenue and much lower profits. Paramount is down 63% from its peak last year. Shares of Paramount now trade for 0.51 times sales, nearly half the 5-year average, and well under the sector average valuation. In fact, shares are so cheap here that Warren Buffett added to his stake in the last 3 months, with Berkshire now owning 15% of the company. Now, it's really interesting here that Buffett would wade into those streaming wars so heavily, own that much of one company, when even though the shares are cheap, there is so much uncertainty in competition and the streaming market. Earnings are expected to rebound higher to $1.70 a share next year on 6% revenue growth, and it's only a matter of time before advertisers come back when the economy starts growing again. Paramount investors do earn a 4% dividend yield while they wait, which definitely makes it worth it. In the communication services group, I also like Warner Brothers Discovery, ticker WBD, and AT&T, ticker T for those cheapest stocks. Energy stocks have been weaker this year after last year's boom, and we're just starting to see some value come back, especially in Phillips 66, ticker PSX. Now, I like Phillips because it's got more diversified revenue stream than you see with most of these larger oil companies. Besides the familiar retail gas stations, the company has refineries, midstream pipelines, and chemicals business that really sets it apart. I love the diversification here, and it's got a strong balance sheet with enough cash flow to support that 4.2% dividend. Now, sales growth will weaken this year for energy stocks as oil stabilizes around $80 a barrel, but these are still cash flow stocks, and PSX is trading for just 0.28 times on that price to sales basis, a 30% discount to the long-term average. 3 other stocks nearly made our list for the cheapest energy stocks, with Valero Energy, ticker VLO, Marathon Petroleum, ticker MPC, and Southwestern Energy, ticker SWN. In the industrial sector, a lot of homebuilder stocks are extremely cheap right now, with Geldwin Holdings, ticker JELD, trading at a multi-year discount. Of course, weakness in the housing market and new construction has hit this entire industry, and Geldwin is trading for just 0.23 times sales. That's less than half the 5-year average valuation. Now, housing isn't likely to turn around this year, so there could be more pain to come, but this is a profitable company and a leader in the manufacturing of those windows and doors. And while the balance sheet isn't as strong as I'd like to see here, with just $2 billion in debt, the company has the financial strength to survive to a next recovery. It was as high as $30 a share last year, and even if it takes 2 years to get back there, that is a 130% return. Runners-up for the cheapest industrial stocks include heavy equipment maker the Montauk Company, ticker MTW, and Pitney Bowes, ticker PBI. Now, I think Montauk could do especially well here as that infrastructure spending ramps up over the next few years. This next value stock really surprised me, but before that, you're going to notice most of these stocks don't pay much in the way of dividends, and you know we love us some dividends here on the channel. That's why I started a new series helping you create the perfect dividend portfolio. Each video, I'll highlight a different dividend strategy and a group of stocks, then reveal the best stocks in the list to put in your portfolio. Check out the first video here or linked in the description below. My cheap stock and consumer discretionary is going to be controversial. Shares of Stitch Fix, ticker SFIX. Now, I've been following Stitch Fix since 2019, first recommending it at $22 a share before it surged past $90 during the pandemic. It's back down to just $5 a share here, crashing with the rest of e-commerce, but could be one of the best rebound stocks in the market. The company is an online fashion service that touches a lot of the disruptive ideas beyond e-commerce, including data analytics and AI. It's using data-driven algorithms and human intuition to help match people with their perfect look. Customers create a profile that assesses their preferences and then matches them with a stylist. Then it powers that retail services and delivering the products. This all means that even on a slowdown in the number of users, revenue per user is still climbing because the more someone uses the platform, the better their customer experience gets. It's why I think even if the stock doesn't rebound this year, investors could still get a solid return on a potential acquisition offer. Any traditional apparel retailer would kill to have this kind of data-driven platform and the AI used by Stitch Fix. It may only be a matter of time. It is risky though because the company is still far from profitable and burning through cash. It's got the balance sheet to survive though and is trading for just 0.28 times sales an 85% discount to its 5-year average valuation. And e-commerce growth stock trading like a beaten-down brick-and-mortar retailer. Now, if you don't like that risk and Stitch Fix, you might also check out shares of the Gap, ticker GPS, trading for just 0.32 times on that price-to-sales ratio. In the consumer staples sector, Cal-Maine Foods, ticker CALM, also made our Dividend Growers video recently and offers a 5.4% dividend. Cal-Maine is the largest U.S. producer and distributor of fresh eggs with a full 20% of the market and $1.8 billion in annual revenues. The company has a fully integrated operation from feed mills to breeding, production, packaging, and distribution, giving it the profit drivers at every step of the business. Now, with that volatility in egg prices lately, that supply chain integration is a bonus that just helps keep costs down and revenue stable. And the company has used that competitive advantage to return cash to shareholders, increasing the dividend by 75% annually over the last 5 years from just 8 cents a share to $1.35 last year. Shares here trade for 1.18 times sales, about an 18% discount to the long-term valuation, and a PE ratio of just 6.3 times. Grocer leader The Andersons, ticker ANDE, nearly made our list of cheapest stocks with its price-to-sales ratio of 0.09 times revenue. Get your free Bowtie Weekly newsletter with the link below, or click on the video to the right for the first in our Perfect Dividend Portfolio series, helping you create the cash flow you can count on. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.